Most traders set a $1,500 weekly target and blow up their accounts within 3 months. Here's the brutal truth. Chasing that number is exactly what prevents you from ever reaching it consistently. The amateur sees $1,500 per week and immediately starts calculating position sizes to force the outcome. They need the money this week. They take oversized positions. They ignore stop losses. They average down on losers. By Friday, instead of being up $1,500, they're down $2,000. That's not bad luck. That's bad structure. There is a specific psychology that destroys more trading accounts than any market crash, any bear market, or any sudden news event. It starts on Sunday night when a trader looks at their account and says, "This week, I'm making $1,500. On paper, it sounds focused. It sounds like a goal. In reality, it is the first step toward emotional trading. The moment you lock onto that number, every decision you make during the week is filtered through one question: will this get me closer to $1,500? That sounds logical, but it is lethal. Because now you are not evaluating trades. You are not weighing risk. You are not thinking like a professional. You are thinking like someone who needs the market to pay a bill. Amateurs start with the outcome and work backward. Professionals start with survival and work forward. This distinction separates traders who last from traders who disappear. When you begin with a dollar target, every decision you make becomes corrupted by that need. You see setups that aren't there. You hold positions longer than you should. You convince yourself that a losing trade will turn around because you need it to. The market doesn't care what you need. It only responds to what you do. Picture this: you have a $10,000 account. You decide, I need 15% returns weekly to hit my target. The math seems simple enough. 15% of $10,000 is $1,500. You scan for volatile names, high beta stocks, big movers. You find a stock trading at $50 that looks ready to move. You buy 1,000 shares, putting $50,000 worth of stock into play with your $10,000 account. You're using maximum margin, maximum leverage, maximum exposure. Your stop loss is at $45, which means you're risking $5,000 to make $1,500. One bad trade wipes out half your account. 3 bad trades and you're finished. But it gets worse. Because you need that $1,500, you don't just take one oversized position. You take 3 or 4 throughout the week. Each one carries the same fatal flaw. The position size is determined by your desired profit, not by acceptable risk. Monday's trade loses $1,200. You're already behind. Tuesday, you try to make it back with an even bigger position. That one loses $1,800. Now you're down $3,000 for the week, and it's only Wednesday morning. The psychological damage is severe. You're trading angry. You're trading desperate. You're trading to recover instead of trading to profit. Here's what happens in real time with that oversized position. The stock ticks against you first. It dips to $49, then $48.50. With your 1,000 shares, every 20 cents is $200 up or down. Your heart rate jumps. You watch every tick. You second-guess your plan. Maybe you move your stop further away. Maybe you remove it entirely. You are no longer trading the setup. You are trading your fear. When you risk $5,000, every tick of the stock becomes agony. You hold losers too long, hoping they'll come back. You exit winners too early because you're terrified of giving back gains. You make every decision from a place of fear instead of logic. Now picture the professional approach, same $10,000 account, but they ask a different question. What's the maximum I can lose per trade and still be alive in 6 months? Their answer, 2% per trade, maximum $200 risk. This single shift in thinking changes everything. The professional isn't thinking about what they can make. They're thinking about what they can afford to lose. They know that survival is the prerequisite for profit. You can't compound gains if you're not around to make the next trade. The professional looks at that same $50 stock. They see the same setup. But instead of thinking about the profit, they look at the chart and identify where the trade fails. They see support at $47. That's $3 of risk per share. Now comes the discipline that separates the elite from the herd. With a $200 risk limit on that $50 stock with a $47 stop, they buy exactly 66 shares. Position size CAC, $3 per share risk. $200 risk. Care 66 shares. The amateur bought 1,000 shares. The professional buys 66. This feels pathetic to the amateur. They look at 66 shares and think, how am I ever going to get rich buying 66 shares? If the stock goes up $8, they only make $528. That's not their target, and that is exactly why the amateur stays poor. They are addicted to the fantasy of the home run, while the professional is addicted to the mathematics of survival. If the trade hits their $58 target, they make $528. Not $1,500, but they're still in the game. More importantly, if the trade fails and hits the stop at $47, they lose exactly $200. Their account drops from $10,000 to $9,800. That's a 2% drawdown. Painful, but survivable. They can take that loss 4 more times this week and still have $9,000 left. They're not out of the game. They're not trading emotionally. They're following a system that protects them from themselves. When you risk $200, you can think clearly. You can follow your plan. You can cut losses without hesitation, because the pain is manageable. The professional with 66 shares feels the move when the stock dips, but $200 of risk is $200 of risk. It's already accepted, both intellectually and emotionally. They are not shaken because the loss is predefined. When the stock finally turns and moves higher, they let it work. Here's what happens over the course of a month with this approach. The professional takes 20 trades. They risk $200 on each one. Their win rate is only 40%, which means they win 8 trades and lose 12. But their winners average $600 each because they're targeting 3-to-1 reward to risk ratios. Their losers average $200 each because they cut losses fast. 8 wins at $600 equals $4,800 in gains. 12 losses at $200 equals $2,400 in losses. Net profit for the month, $2,400. That's $600 per week average. They didn't hit $1,500 weekly yet, but they're building capital safely. Their account is now $12,400. Next month, their 2% risk becomes $248 per trade instead of $200. Same process, same win rate, but now they're making $744 per week average. By month 6, if they maintain the same discipline, their account has grown to $25,000. Now their 2% risk is $500 per trade. Same 3-to-1 ratios mean they're averaging $1,500 in profit per winning trade. With a 40% win rate over 5 trades per week, they're finally hitting that $1,500 weekly target consistently. Here's the paradox that most traders never grasp. You reach $1,500 per week by making each individual trade feel small and safe. The amateur tries to make $1,500 on 1 or 2 big swings. The professional makes $1,500 by stacking small, controlled wins over time. The amateur risks everything to get there fast. The professional risks almost nothing and gets there inevitably. One approach feels exciting. The other feels boring. One destroys accounts. The other builds wealth. The psychological difference is profound. Fear is the most expensive emotion in trading. It costs more than greed, more than hope, more than pride. And oversized positions guarantee you'll trade in fear. Get the position size right, and everything else becomes easier. You can wait for better setups. You can honor your stops. You can let winners run. You can trade like a professional instead of gambling like an amateur. You have to decide right now which game you are playing. Are you playing the lottery, risking it all for a dopamine hit? Or are you running a business where capital management is the only thing that matters? The moment you set a hard weekly income target, you have stopped trading the market and started trading your own desires. You are no longer looking at the chart to see what is actually there. You are looking at the chart to see what you need to be there to pay your bills. The real secret isn't in the target. It's in the mathematics of survival. It's in understanding that your position size determines your psychology, and your psychology determines your results. The $1,500 target isn't a ceiling. It's not a quota. It's a byproduct. It's what happens when you execute a boring, repetitive, risk-managed process over a large sample size of trades. If you chase the money, it runs away. If you focus on the process, the money has no choice but to show up. The greatest trader who ever lived, Jesse Livermore, made and lost millions of dollars learning this specific lesson. He didn't lose his fortune because he picked the wrong stocks. He didn't lose it because he couldn't read the tape. He lost it because he violated the mathematics of safety. He forgot the foundational rule that governs every professional decision. And that starts with understanding the 2% rule that Jesse Livermore learned the hard way. Jesse Livermore made and lost fortunes multiple times before he learned this lesson. The biggest mistake wasn't picking the wrong stock. It was sizing the position wrong. This should be tattooed on every trader's screen. Livermore could read the tape better than anyone alive. He could sense pivotal points days before they materialized. He had the intuition to call the 1929 crash and the courage to short into Black Tuesday when everyone else was being destroyed. He made $100 million in a single day, yet he found himself bankrupt over and over again. Not because his market analysis was wrong, not because he couldn't identify trends. He went broke because he violated the mathematics of position sizing. He risked too much on individual trades when he was winning and became reckless when he felt invincible. This realization brings us to the single most important rule in professional trading, the rule that separates the solvent from the bankrupt, the rule that transforms gambling into business, the 2% law. It states that you never risk more than 2% of your total trading capital on any single trade. With a $10,000 account, that's $200 per trade. Not $500, not $1,000, exactly $200. Notice the word risk. This doesn't mean you only buy $200 worth of stock. It means that if the trade fails and hits your stop loss, the amount of money that vanishes from your account is no more than 2% of your total balance. This is not a suggestion. This is not a guideline that you follow when you feel like it. This is the mathematical foundation that separates traders who survive from traders who disappear. Every professional trader you've ever heard of follows some version of this rule. The exact percentage might vary. Some use 1%, some use 2%. A few aggressive traders might push to 3% on their highest conviction ideas. But no one who lasts risks 10% or 20% on a single position. That's not trading. That's gambling with a loaded gun pointed at your bank account. Amateurs hate this rule with a passion. They despise it. When an amateur hears they can only risk $200, they feel insulted. It feels pathetically small. They look at the potential profit from a $200 risk and think, I can't quit my job making $400 on a trade. They want to swing for the fences. They want to double the account in 3 months. They see other traders on social media posting screenshots of massive wins and assume those traders are risking big to win big. What they don't see are the blown accounts, the margin calls, the traders who posted one big win and then disappeared forever because the next trade wiped them out. Survivorship bias hides the bodies. Professionals know something the amateur ignores. Survival comes first, profits come second. You cannot compound returns if you don't survive long enough to compound. If you risk 10% on a trade, a string of 5 bad trades, which happens to everyone, leaves you with half your money gone. To get back to even, you now need to make 100% returns on what's left. That is a mathematical death spiral. But if you risk 2%, you can be wrong 10 times in a row, a disastrous streak, and you still have more than 80% of your capital intact. You are still in the game. You are still alive. And if you are alive, you can catch the next trend. Here's what the math actually looks like for reaching that $1,500 weekly target. It seems impossible to make $1,500 a week risking only $200, doesn't it? That's because the amateur thinks in terms of one big trade. The professional thinks in terms of ratios, frequency, and scaling. To make this work, you need a 3-to-1 reward to risk ratio. This is the engine of profitability. It means for every dollar you risk, you must have a realistic expectation of making $3. If you risk $200, your target profit must be at least $600. Let's play out a typical week for a professional swing trader starting with a $10,000 account. You find 5 high-quality setups that meet your criteria. You take all 5 trades. You risk exactly $200 on each one. The market is choppy. It's a difficult week where most traders get chopped up. You lose on the first trade, minus $200. You lose on the second trade, minus $200. You lose on the third trade, minus $200. You are now down $600. The amateur would be panicking. increasing their size to make it back. The professional stays calm because they know the math. The fourth trade works. It hits the target. Plus $600. The fifth trade works. It hits the target. Plus $600. Look at the result. You lost 3 times. You won only 2 times. Your win rate was a pathetic 40%. You were wrong more often than you were right. 3 losses cost you $600. 2 wins paid you $1,200. Your net result for the week is positive $600. You didn't hit $1,500 yet, but you made money in a week where you were mostly wrong. This is the power of structure over emotion. Now watch what happens as your account grows through disciplined compounding. At $15,000, your 2% becomes $300 per trade instead of $200. Same strategy, same 3-to-1 ratio, same 40% win rate. But now each winner pays $900 instead of $600. 5 trades per week, 2 winners, 3 losers. 3 losses cost $900. 2 wins bring in $1,800. Net result, $900 per week. You didn't change anything about your trading. You didn't take bigger risks. You didn't increase your win rate. The account grew, so the position size grew proportionally, and the profits scaled automatically. Push that account to $25,000 through consistent execution. Now your 2% risk is $500 per trade. Target $1,500 per winner using the same 3-to-1 structure. 5 trades, 2 winners, 3 losers. Losses total $1,500. Winners total $3,000. Net weekly profit, $1,500. You've hit your target, and you did it without ever risking more than 2% of your account. You achieved the aggressive goal through conservative means. This is the paradox of safe swing trading. The slower you try to go, the faster you actually get there. Compare this with where most traders fail. They risk $500 to make $500. A 1-to-1 ratio. They see a stock at $50, set a stop at $48, and set a target at $52. $2 of risk for $2 of reward. This feels fair to the amateur. It feels balanced. In reality, it's a death sentence. With a 1-to-1 ratio, you need to win over 50% of your trades just to break even. But that ignores commissions, slippage, and emotional errors. Once those creep in, you often need closer to a 60% win rate just to stay positive. Do you know how hard it is to be right 60% of the time consistently? It's nearly impossible for most traders. The pressure is immense. Let's run the numbers on a bad week with 1-to-1 ratios. You take 5 trades. You lose 3, win 2. 3 losses at $500 each cost you $1,500. 2 wins at $500 each bring in $1,000. You're down $500 for the week despite winning 40% of your trades. The same win rate that produces $600 profit with 3-to-1 ratios produces a $500 loss with 1-to-1 ratios. This is why amateurs are constantly confused about why they can't make money even when they feel like they're picking decent trades. The math is working against them before they even click the buy button. The protocol for implementing the 2% law is rigid, military grade, and non-negotiable. You cannot guess. You cannot eyeball it. You must follow the calculation for every single trade. First, identify your entry price and your stop-loss price based on the chart, not your wallet. Where does the trade technically fail? That is your stop. Let's say you want to buy a stock at $50, and the support level is at $47. Your stop distance is $3 per share. Second, calculate your total risk dollar amount. That is 2% of your current account balance. If you have $10,000, that number is $200. Third, divide your total risk dollar amount by your stop distance. Position size, $3, $200. COCF 66 and 67 shares. You round down to 66 shares. That is your position size. No exceptions. No feeling good about this one. No insider tips. The math dictates the size. If the stop needs to be $5 away, you buy 40 shares. If the stop is $1 away, you can buy 200 shares. The number of shares changes, but your risk, the $200, remains frozen. This creates emotional stability. You are never surprised by a loss. You know exactly what it will cost before you enter. Here's what happens psychologically when you respect the 2% law. You enter the trade, the stock moves against you, hits your stop, you lose $200. You feel it. You don't like it. But you're not scared. You're not angry. You're not desperate to make it back. You simply review the trade, identify what went wrong if anything, and move on to the next setup. Your decision-making process remains intact. You can still think clearly. You can still follow your rules. The loss was painful but not crippling. Now here's what happens when you violate it and risk 20%. You enter the trade, the stock moves against you, you start sweating. You remove your stop loss because you can't afford to take a $2,000 hit. The stock keeps dropping. You're down $2,500. You hold, hoping it will come back. It doesn't. You finally panic and sell at the worst possible moment, locking in a $3,000 loss. Your $10,000 account is now $7,000. You're emotionally destroyed. You can't think straight. You either quit trading for weeks, or worse, you start revenge trading to make it back. Either way, your career is in jeopardy because of one trade. The 2% law protects you from yourself. It protects you from your own overconfidence when you're winning. It protects you from your own desperation when you're losing. It removes emotion from position sizing and replaces it with mathematics. And mathematics don't care about your feelings. They just work. When you size correctly, you remove the fear of ruin. You stop staring at the profit and loss column and start looking at the chart. You detach your self-worth from the outcome of any single trade because you know that no single trade can hurt you. You become the casino, not the gambler. The casino doesn't care if a player wins a hand of blackjack. They know that over 1,000 hands, the math guarantees they will win. Position size separates setbacks from blow-ups. That's the maxim to burn into your memory. A setback is a $200 loss that stings but doesn't change your life. A blow-up is a $2,000 loss that puts you on tilt, destroys your confidence, and forces you to take a month off to recover psychologically. The only difference between a setback and a blow-up is position size. The market doesn't care about your account size. It will move against you the same percentage whether you have $10,000 or $100,000. But if you're risking 2% versus 20%, the emotional impact is completely different. But even with perfect position sizing, even with the 2% rule locked in stone, you will still lose money if you don't know when to enter. You can size a trade perfectly, but if you buy a falling knife or jump in before the market confirms the move, you're just managing your way to a controlled loss. Most setups fail because traders jump in too early, before the market confirms the move is real. They see the pattern, they calculate the size correctly, and they pull the trigger before the market invites them in. Position sizing keeps you safe, but confirmation gets you paid. It was never my thinking that made the big money for me. It was always my sitting. Jesse Livermore wasn't talking about holding winning trades longer. He was talking about the hardest discipline in trading, doing nothing until the market proves itself worthy of your capital. Most traders read that quote, nod their heads, then immediately ignore it. They think sitting means being lazy or missing opportunities. In reality, sitting is the most active decision you can make. It's choosing to preserve your capital until the market begs you to take it. Most traders lose money not because they pick bad stocks, but because they enter too early. They see a setup forming, and their brain lights up with possibility. A clean pullback. A textbook breakout. A moving average bounce. The pattern looks perfect on the chart, so they buy immediately, terrified of missing out. They're trading their own anxiety, not the market's reality. They buy the hope of a move instead of the proof of one. And hope is the most expensive emotion in trading. Here's the fundamental distinction that separates consistent winners from perpetual strugglers. Amateurs trade setups, professionals trade confirmation. That single sentence contains more trading edge than most people extract from years of chart study. A setup is potential. It's a suggestion. It's a pattern that whispers, something might happen here. But confirmation is proof. It's the market screaming, something is happening right now. The amateur buys the whisper. The professional waits for the scream. Let's define this clearly with concrete terms. A setup is a pattern on your screen. It's a stock pulling back to the 50-day moving average. It's a breakout forming at resistance. It's a flag consolidating after a strong move. These patterns have names, textbook definitions, and clean historical examples. They look beautiful in trading books where every example works perfectly. But in real time, most setups fail. They fail because a pattern is just lines and bars on a screen. It doesn't tell you if institutional money is behind the move. It doesn't tell you if this is the start of something real or just noise that will fade by tomorrow. Confirmation is the market proving the setup is legitimate through objective evidence. It's volume spiking as real buyers flood in. It's a gap up showing overnight conviction. It's momentum accelerating as the price breaks through levels without hesitation. Confirmation transforms a picture of fire into actual flames. One looks dangerous on paper, the other will burn you if you get too close. Professionals wait to see the flames before they act. Picture this scenario in complete detail. You're scanning charts Sunday night, preparing for the upcoming week. You spot a stock that has been trending higher for 2 months. It ran from $30 to $50, then pulled back over 3 days to rest at $45. The 50-day moving average sits exactly at $45. Volume dried up during the pullback, which is healthy action. Everything about this screams textbook continuation pattern. The stock should bounce here and resume its march toward $55 or $60. You calculate your position size using the 2% rule. With your $10,000 account, you're risking exactly $200. Your stop loss sits at $43, $2 below the support level. That's $2 of risk per share, so you can buy exactly 100 shares. Your target is $51, giving you a clean 3-to-1 reward to risk ratio. The trade looks flawless on paper. Monday morning arrives. The stock opens right at $45. The amateur sees this and immediately hits the buy button. They don't want to miss it. The setup is too perfect. They execute the trade, lean back in their chair, and start calculating profits. But something subtle happens that they miss entirely. The stock doesn't move with any conviction. It trades sideways all day between $44.80 and $45.20. Volume is weak, barely half the daily average. There are no buyers stepping in with size, no institutions showing interest, no momentum building. Tuesday brings more of the same. The stock drifts between $44.50 and $45.50. Still no energy. Still no volume. The amateur holds because they haven't hit their stop yet, but doubt creeps in. By Wednesday, selling pressure finally arrives. The stock breaks below $44, triggering nervous selling from other early buyers. Thursday morning it gaps down to $42.80, hitting the amateur's stop loss. They're out with a $200 loss on what looked like a perfect setup. What went wrong? The pattern was correct. The level was valid. The risk management was proper. The failure happened because they bought the suggestion instead of waiting for proof. They assumed other buyers would step in at $45 simply because it looked logical on a chart. The market doesn't care about your logic. It only responds to actual buying pressure. Now replay that exact scenario through professional eyes using the confirmation filter. Same stock. Same uptrend. Same pullback to the 50-day moving average at $45. Same potential risk and reward structure. But this time, a different approach governs every decision. The stock touches $45 on Monday. The professional sees it. They have the same chart, the same setup, the same opportunity. But they do absolutely nothing. They sit. They watch. They treat the buy button like it's radioactive. Monday closes with the stock at $44.90 on weak volume. No trade. Tuesday brings more sideways action, with the stock closing at $44.60. Still no trade. The setup remains valid, but there's zero confirmation. The market hasn't proved anything yet. Wednesday morning changes everything. The stock gaps up from $44.60 to $46.20 on the open. Volume in the first hour already equals yesterday's entire session. Buyers are showing urgency, paying higher prices, demonstrating conviction. The candle pushes higher throughout the day, closing near $46.50, with volume running 200% above average. That's confirmation. The market just proved that demand has stepped in at that support zone with real money. Now, and only now, does the professional enter. They buy at $46.50 with a stop at $44.50 and a target at $52.50. Notice what happened. The professional paid $1.50 more per share than the amateur who bought at $45. The amateur thinks this is stupid. You miss the bottom. They protest. You gave up profit. But the professional understands the mathematics of probability. By waiting for confirmation, they sacrificed a small slice of potential profit to eliminate massive amounts of risk. They cut their failure rate by approximately 70%. They're not guessing that the stock will bounce. They're joining a bounce that's already underway with institutional participation. They're buying strength, not hoping for strength. This psychological hurdle destroys more traders than any technical concept. You must be willing to pay a higher price for a higher probability. The amateur wants the perfect entry price. The professional wants the perfect trade. These are rarely the same thing. When you buy at the exact support level, you're catching a falling knife. When you buy the confirmation, you're catching a rising rocket. What Jesse Livermore called pivotal points are these exact moments when the market shifts character and reveals its true intention. He didn't predict these points. He watched the tape and reacted when they appeared. A pivotal point isn't when a stock touches support. It's when the stock bounces off support with conviction and volume. It's not when price nudges above resistance by a few cents. It's when it blasts through, holds above, and closes strong with expanding volume. The pivot is the proof. Think of confirmation as the market's invitation. A setup gets your attention, but confirmation earns your capital. You're not forcing your way into trades. You're waiting for the market to invite you in with clear signals that real money is moving. This creates a profound psychological shift. When you buy without confirmation, you're immediately anxious, hoping the market will save you. When you buy confirmation, the market has already started saving you. You're entering a current that's flowing in your direction. Here's the protocol for implementing confirmation, and it's non-negotiable. Never enter on setup alone. You need one of 3 specific triggers before risking capital. First, a volume spike where trading volume exceeds 150% of the stock's average daily volume. This tells you real buyers are stepping in, not just retail traders gambling on a pattern. Second, a gap up of at least 1% from a key level, showing that buyers were willing to pay premium prices overnight. Third, momentum acceleration where the stock breaks through resistance with expanding volume and closes in the top third of its range. Combine this with a time filter. If confirmation doesn't appear within 2 trading days of the setup triggering, you walk away. Delete the trade from your watch list. Move on. The setup was a mirage. This is crucial because most traders will sit on dead setups for weeks, hoping they'll eventually work. That's not patience. That's stubbornness. True patience means accepting when the market isn't interested in your idea. The maxim to remember is this: patience is the highest paid skill in trading. Not intelligence, not speed, not access to insider information. Patience. The ability to sit on your hands while everyone around you is acting impulsively. The ability to watch perfect-looking setups and not pull the trigger until the market forces your hand. This is what separates the top 10% from the struggling masses. Here's what happens over time when you apply the confirmation filter religiously. Over 3 months, you identify 30 potential setups. Without confirmation, you might take all 30 trades. With confirmation, only 18 actually trigger your entry criteria. You took 40% fewer trades, but your win rate on those 18 jumps from 35 to 65%. You won 12 trades and lost 6. With proper 3-to-1 ratios, those 12 winners generated $7,200 while the 6 losers cost $1,200. Net profit, $6,000 over 3 months. Compare this to the trader who took all 30 setups without waiting for confirmation. They won 11 and lost 19. Same 3-to-1 ratios produced $6,600 in gains and $3,800 in losses. Net profit, $2,800. Same market, same opportunities, but the patient trader made more than double the return by taking fewer, higher-quality trades. The psychological benefits compound over time. When you wait for confirmation, you shift responsibility from your opinion to the market's behavior. You stop trying to be right and start trying to align with strength. You no longer need to predict when a stock will move. You just need to recognize when it's already moving with conviction. This reduces mental stress dramatically. You're not forcing trades or gambling on hope. You're filtering opportunities and joining strength. Cash becomes a position in this framework. Sitting on the sidelines isn't doing nothing. It's actively preserving capital for the highest probability opportunities. Amateurs feel guilty when they're not in trades. They think they're missing out or being lazy. Professionals understand that most days in the market are noise, and only a few days really matter for their annual returns. They're willing to miss dozens of mediocre setups to catch the handful of confirmed moves that drive their profits. Think of the market as a courtroom, where you're the judge. The setup is the accusation. This stock is ready to move higher. But in court, the defendant is innocent until proven guilty. In trading, a setup is false until proven true through confirmation. You don't render your verdict until you've seen the evidence. You let the market present its case through volume, gaps, and momentum. Only when the evidence is overwhelming do you rule in favor of the trade. But once you've waited for confirmation, once you've entered a high-probability trade at the right moment, once the market starts proving you right with follow-through and momentum, you face a new challenge. Most traders immediately want to take profits, scared of giving back their gains. But hitting aggressive weekly targets like $1,500 requires more than just picking winners. It requires maximizing them. You need to know how to take a good trade and transform it into a great one without violating your risk management rules. You need to understand the art of adding to strength without adding risk. You waited for confirmation. You entered with perfect position sizing. The stock is moving in your favor. You're up $400 on your $200 risk. This is the most dangerous moment in a trade. Not when you're losing money. Not when you're confused about direction. When you're winning. Because this is when most traders sabotage themselves with their own success. The amateur looks at that open profit and feels a surge of anxiety masquerading as wisdom. I should lock this in, they think. Nobody went broke taking a profit. A bird in the hand is worth two in the bush. They hit the sell button, banking their small gain, then watch in horror as the stock continues running without them. They took a snack when they could have had a feast. They traded their fear, not their edge. The professional sees the same $400 profit and asks a completely different question. How can I use this strength to safely press my advantage? They don't rush to take money off the table. They don't celebrate prematurely. They execute the next phase of their plan. They do something that feels completely counterintuitive to the amateur mind. They buy more stock at a higher price. This is pyramiding, the secret weapon for turning good trades into great ones without increasing your actual risk. It's the mathematical difference between a trader who makes $600 per week and a trader who consistently hits that $1,500 target. Most people think making big money requires taking big risks. Pyramiding proves you can make exponentially more money while taking zero additional risk if you understand how to finance your expansion with the market's own money. The psychology behind this technique runs counter to every instinct the amateur has developed. When a stock rises from $50 to $52, your brain screams, "It's too expensive now. You missed the best price." This is chasing. You feel like you're overpaying. But in trading, price is not value. Price is truth. If the stock is at $52 and rising on volume, the market is telling you that your analysis was correct. Demand is exceeding supply. Institutional money is flowing in. Strength begets strength in trending markets. Amateurs do the exact opposite of what works. They add to losing positions because stocks are cheaper after they fall. They call it averaging down or lowering their cost basis. In reality, they're throwing good money after bad, building a pyramid in the wrong direction. They're adding size to ideas that are proving them wrong. Conversely, they cut winning positions short because they're terrified of giving back gains. They sell strength and buy weakness. This behavior guarantees mediocre results. Jesse Livermore understood this when he spoke about letting profits run. He wasn't advocating blind hope or stubborn holding. He was describing a structured, disciplined method of backing your winners with increasing size as they proved themselves correct. He would test the market with a small position. If it moved against him, he cut it immediately. But if it moved in his favor, he viewed it as the market giving him permission to deploy serious capital. His massive fortunes came not from being right more often, but from being heavily invested when he was right. Let's walk through the exact pyramiding protocol using numbers you can feel. You identify a confirmed setup on a stock trading at $50. You've waited for the volume spike and gap up that signals real institutional buying. Your stop loss sits at $48, giving you $2 of risk per share. With your $10,000 account and the 2% rule, you risk exactly $200. You divide your risk by your stop distance. Position size trick. $2 per share risk. $200 risk. CalScare 100 shares. You enter at $50, stop at $48, targeting $56 for a clean 3-to-1 reward to risk ratio. Your total position value is $5,000. Your risk is $200. Your potential profit is $600. The stock immediately validates your entry. It closes the first day at $50.80 on strong volume. Day 2 it pushes to $51.50. By day 3, it's trading at $52. You're now up $200 in unrealized profit, sitting on a 1-to-1 gain against your original risk. Here's where amateurs and professionals permanently diverge. The amateur thinks, I should take this before it disappears. They sell all 100 shares, lock in $200, feel good about their discipline, and start hunting for the next setup. They just turned a potential home run into a single. They'll need to hit 5 of these small winners just to offset one $200 loss, assuming they can maintain perfect execution under pressure. The professional executes the critical first step of pyramiding. They move their stop loss from $48 to their entry price of $50. Stop and think about what just happened mathematically. If the stock reverses now and falls back to $50, they get stopped out at break-even. They lose nothing. They make nothing. But their original $200 risk has just vanished. The trade is now a free roll. They can't lose money on it anymore. That zero-risk moment is when pyramiding becomes possible. You never pyramid while your original risk is still active. You only pyramid when the market has paid you enough to eliminate your exposure. Once your stop is at break-even, the worst-case scenario is getting knocked out flat. Your account remains intact. Your capital is preserved. You've earned the right to press your advantage. Now comes the power move. Since you have zero risk on the first 100 shares, you can use your unrealized $200 profit to finance a second entry. You buy another 50 shares at $52. Notice the size reduction. You don't buy another 100 shares. You scale down as you price up, buying half your original position. This maintains stability and prevents the inverted pyramid structure that can topple with any pullback. Why exactly 50 shares? Because the mathematics must remain consistent. Your new stop sits at $50, which is $2 away from your new entry at $52. You want to risk approximately the same dollar amount on this second tier. With $2 of risk per share, you can add 50 shares while risking $100 on this addition. But here's the critical detail that makes pyramiding magical. If the stock hits $50, your first 100 shares break even, and your second 50 shares lose $2 each, or $100 total. Total risk after pyramiding / versed plus $100 second vision / $100. You now own 150 shares with half the risk you started with. You've increased your position size by 50% while cutting your total exposure in half. You have more upside potential with less downside risk. This is the mathematics of professional trading, using the market's money to amplify your edge while protecting your capital. If the stock continues to your $56 target, the profit calculation becomes staggering. Your first 100 shares make $6 each for $600 profit. Your second 50 shares make $4 each for $200 profit. Total, $800. Compare this to the amateur who sold at $52 for $200. Same setup, same market move, but the professional made 4 times the profit by adding to strength instead of taking quick gains. This is how professionals turn a $400 winner into a $900 winner. The difference between a good week and hitting your $1,500 target consistently. If you take 5 trades per week and win on 2 of them, but you pyramid those winners properly, your average gain per winner jumps from $600 to $900 or more. Your 3 losers still cost $200 each for $600 total, but your 2 winners now bring in $1,800 instead of $1,200. Net weekly profit increases from $600 to $1,200 without changing your win rate or initial risk tolerance. The maxim you must burn into your memory is this: add to your winners, never to your losers. This single behavioral shift will transform your results more than any technical indicator or chart pattern. Most traders invert this completely. They cut winners short because they're afraid of giving back gains, and they hold losers long because they're hoping for recovery. They end up with portfolios full of their worst ideas and empty of their best ideas. Their small winners can't overcome their large losers. The psychological benefits of proper pyramiding compound over time. When you pyramid correctly, you're not stressed about the trade. You're not biting your nails or checking prices every few minutes. You have 150 shares, the stock is moving up, and you know that even in the worst-case scenario, you only lose $100. You're in complete control. You're driving the trade isn't driving you. This sense of calm allows you to hold for bigger targets because your downside is mathematically secured. But pyramiding comes with rigid rules that must be followed precisely. First, only pyramid in the direction of a clear, confirmed trend with no major resistance levels immediately overhead. Never pyramid into obvious supply zones. Second, every addition must be financed by open profit, never by fresh account equity. Your total risk should never exceed your original risk tolerance. Third, every addition must be accompanied by a stop adjustment that protects your accumulated gains. Fourth, limit yourself to 2 or 3 pyramid levels maximum. Beyond that, you risk overconcentration and psychological overattachment. When you respect these rules, pyramiding becomes an accelerator that allows you to do less and earn more. Instead of hunting for 10 mediocre setups every week, you find 3 excellent ones and work them properly. You stop overtrading. You become a sniper who waits for high-probability situations, executes with precision, and maximizes every advantage the market offers. The technique also solves the frustrating problem of being right but small. Nothing hurts more than correctly predicting a massive 20% move but only having a tiny position because you were being overly cautious. Pyramiding allows you to start cautious, risking only that initial $200, but end big. You earn the right to size up. You don't force exposure on day one. You let the market earn your size day by day through its own behavior. Think about what this does to your weekly and monthly results. You might only need 1 or 2 well-pyramided trends per month to hit your targets. You stop feeling pressure to trade every day. You stop forcing setups that aren't there. You develop the patience of a professional hunter who can wait hours for the perfect shot, knowing that when it comes, proper execution will feed his family for weeks. Livermore called this letting your profits run, but he didn't just mean holding longer. He meant systematically backing his winning positions with increasing capital as they proved themselves worthy. He built his legendary fortune not by being right more often than others, but by being maximally invested when he was right and minimally invested when he was wrong. One properly pyramided winner would offset 10 small losers and still produce spectacular annual returns. But even this advanced technique carries a hidden danger, and this is where many otherwise disciplined traders stumble. After a string of successful pyramids, after a few weeks of expanded profits and smooth execution, something subtle shifts in your psychology. Confidence quietly morphs into overconfidence. You start feeling invincible. You raise your weekly target in your head. You begin looking for just one more trade late in the week to pad your already successful results. You stop walking away when your system has already done its job. That final, unnecessary push destroys more profitable weeks than any market crash or news event. There's one final trap that waits specifically for traders who have mastered every rule perfectly, and it strikes right when you think you've got this game figured out. It's Friday morning. Your screen shows plus $1,650 for the week. You've hit your target with room to spare. The trade's worked. You respected your stops. You waited for confirmation. You pyramided into strength. Everything you were supposed to do, you did. You're sitting on what most traders dream of: a profitable week, target exceeded, no major drawdowns, clean execution. This is exactly where the game becomes lethal. The amateur mind kicks in with one devastating thought: I'm on fire. I can make another $500 before the close. That sentence has destroyed more profitable weeks than any market crash, any news event, any technical breakdown. Hidden inside those words is a complete identity shift. You stop being a risk manager and become a gambler. You stop asking what is the best risk-adjusted decision and start asking how much more can I squeeze out. You've abandoned the process that created your success and replaced it with the greed that destroys accounts. The professional thinks something entirely different when they see that plus $1,650. They think, my business is closed for the week. See you Monday. They treat that number not as fuel for more action, but as a finish line. The work is complete. The inventory is sold. The shop shuts its doors. This isn't laziness or leaving money on the table. This is professional risk management at its highest level. This is the hardest discipline of all, walking away when you're winning. The market is designed to seduce you right here, at your moment of maximum confidence. It knows your psychological weaknesses better than you do. It will flash perfect-looking setups across your watch list. A stock you've been stalking all week will finally hit your level. A news catalyst will drop. A breakout will trigger. You'll feel like the universe is rewarding your discipline with one last golden opportunity. But if you keep trading after hitting your weekly goal, you're no longer trading for income. You're trading for entertainment, for the dopamine hit of seeing green numbers dance on your screen. And the market charges an extraordinarily high price for entertainment. Every casino in the world understands this psychology. They keep the lights bright, the action constant, and the opportunities endless because they know most people can't walk away while they're ahead. Let's walk through what one more trade actually does to you, step by step, because every trader needs to see this movie play out in slow motion. You've locked in $1,650. Your standard risk per trade is still $200, following the 2% rule. You spot what looks like a clean 3-to-1 opportunity. On paper, this seems harmless. Risk $200 to potentially add another $600. Worst case, you finish at plus $450. Still a winning week, right? You enter the trade, but something subtle has shifted in your psychology. You're no longer trading your system, you're trading your ego. The setup isn't quite as confirmed as the ones you took earlier in the week, but you're feeling invincible. Volume is decent, but not exceptional, because it's Friday afternoon and institutional money has already gone home. You convince yourself it's good enough because you want to be in action. The stock moves against you first, as stocks often do. It dips below your entry, testing your conviction. With your earlier trades, you would have honored your stop without hesitation. But this time, you start negotiating with yourself. It's just a little pullback. The setup is still valid. I'll give it more room. You move your stop further away, or remove it entirely. You're no longer trading the setup. You're trading your fear of being wrong, after being so right. The stock continues to deteriorate. By 2 p.m. it breaks through what should have been your stop level. You're down $300, then $400. You finally panic and sell at the worst possible moment, locking in a $400 loss. Your beautiful plus $650 week has become plus $1,250. You've given back $400 of profits that were already yours, but the financial damage is only half the story. You've destroyed your psychological momentum. Friday evening arrives, and instead of celebrating a successful week, you're replaying that unnecessary trade in your mind. Why did I take it? I didn't need it. I was already up for the week. Saturday morning you wake up, and the first thought in your head is that stupid Friday afternoon decision. Sunday you're supposed to be preparing for next week, scanning for setups, planning your approach. Instead, you're still processing the emotional wound of giving back profits. Monday morning arrives and you're not in the right headspace. You're tentative, second-guessing your first setup because you're still carrying Friday's baggage. You pass on a trade that would have worked perfectly. Now you're frustrated about missing opportunities. By Tuesday, you're either overtrading to make up for lost chances, or you're paralyzed and can't pull the trigger at all. One unnecessary trade on Friday afternoon has infected your entire next week. This pattern repeats across thousands of traders every single Friday. They build winning weeks, then sabotage them in the final hours. They can't help themselves. The market is open, so they feel obligated to trade. They confuse activity with productivity. They think more trades equal more profit. In reality, past a certain point, more trades equal more risk with diminishing returns. Understanding this requires recognizing that you're fighting millions of years of evolutionary wiring. When our ancestors found a berry bush full of ripe fruit, they didn't eat 3 berries and walk away. They ate until they were stuffed, because scarcity was the norm, and they didn't know when the next meal would come. That same survival programming fires in your brain when you're winning. You want more. You feel like you should capitalize while conditions are favorable. But the market isn't a berry bush. It's an infinite game designed to separate you from your money through your own psychological weaknesses. The $1,500 target isn't a ceiling, and it isn't a dare. It's a foundation. Think of your trading career as building a brick wall. Each weekly target you hit is a single brick. You lay one brick this week, another next week, another the week after. The work is repetitive, sometimes boring, but after a year you have a wall. After 2 years, you have a fortress. After 5 years, you have financial freedom built on consistent, disciplined execution. But if you keep knocking out your own bricks every Friday afternoon by taking unnecessary trades, you'll never build anything that lasts. You'll be the trader who makes $1,650 one week, gives back $400 the next, makes $900 the following week, loses $700 after that, up and down, running hard on a treadmill that goes nowhere. The market doesn't beat you. You beat yourself. Professional traders understand something that amateurs miss. Trading is a business, and every business has operating hours. A restaurant doesn't stay open until 3 a.m. every night, just because one more customer might walk through the door. The owner knows that every extra hour means additional staff costs, more electricity, more risk of something going wrong, all for marginal gain. A bakery that sells out of bread by 11 a.m. doesn't frantically start baking more loaves at 4 p.m. They put up the sold-out sign, clean the shop, count the register, and go home to their families. When you hit your weekly target, you put up your own sold-out sign. The inventory is gone. The week's work is complete. It doesn't matter if the market rallies 500 points in the final hour. It doesn't matter if your favorite stock breaks out. Those opportunities don't belong to you. They belong to the market. You've extracted your wage for the week. Be satisfied with it. Every time you respect your own rules and shut down after hitting your target, you reinforce the identity of a disciplined professional. You prove to yourself that you're not controlled by greed, excitement, or boredom. You signal to your subconscious that your process matters more than your impulses. You're training your brain what kind of trader you are. Every time you violate that rule just this once, you train the opposite identity. You become the trader who negotiates with their own system. You start believing your rules are suggestions rather than laws. You learn to override discipline whenever the market feels exciting. Over time, that identity will cost you far more than any single bad trade ever could. Here's your complete protocol for safe $1,500 weekly targets, the entire system distilled into 5 non-negotiable commandments. Risk, 2%. Maximum per trade. Survival comes first, profit second. Your position size is dictated by your stop-loss distance, not by your desired profit. This keeps you alive through inevitable losing streaks and prevents any single trade from damaging your account or your psychology. Wait for confirmation before entering any trade. Patterns lie. Volume doesn't. You're not trading setups. You're trading proof that the setup is valid. Gap ups, volume spikes, momentum acceleration, these are your entry triggers. Patience is the highest paid skill in trading. Target 3-to-1 reward to risk ratios on every trade. Mathematics over emotion. This allows you to be wrong 60% of the time and still profit handsomely. You don't need to be right more often. You need to make more when you're right than you lose when you're wrong. Pyramid into winners by adding size only after risk is removed. Use the market's money to finance additional entries. Add to strength, never to weakness. This transforms good trades into great ones without increasing your original risk exposure. Walk away when you hit your target. Discipline preserves profits. The market will always offer one more trade, one more opportunity, one more chance to make a little extra. Professionals ignore these temptations. They understand that unnecessary trades are the enemy of consistent profitability. Follow this system consistently, and your weekly average will approach $1,500 as your account grows through natural compounding. Notice what's not in that promise. You won't hit exactly $1,500 every single week. Some weeks you'll make $400. Some weeks you'll make $2,200. Some weeks you'll lose $200. That's the nature of probabilistic thinking. You're not controlling outcomes, you're controlling process. The moment you start demanding exactly $1,500 every single week, you reintroduce all the psychological demons this system was designed to eliminate. You start forcing trades that don't meet your criteria. You start oversizing positions to hit arbitrary numbers. You start ignoring confirmation because you need the trade to work. You're back to outcome-based thinking instead of process-based thinking. Remember the foundational paradox from Chapter 1. You don't reach $1,500 per week by chasing $1,500 per week. You reach it by protecting every dollar as if your survival depends on it. By only trading the highest quality confirmations. By structuring trades so your winners are always bigger than your losers. By pressing strength instead of forcing action. And by shutting it all down once the job is done. You're not chasing the money. You're following the process. The money follows you. When you chase money, you make desperate decisions. You take trades that violate your criteria. You hold losers hoping they'll recover. You cut winners fearing they'll reverse. You're constantly anxious, constantly second-guessing, constantly at war with the market. When you follow process, you're calm. You know exactly what you're looking for. You wait until the market presents it. You execute according to plan. You manage risk mechanically. You let winners develop naturally. You're not hoping or guessing or gambling. You're running a business that generates income through disciplined execution of a proven mathematical edge. If you can master this weekly rhythm, risk small, wait for proof, confirm strength, build positions properly, then stop when the work is done, you're ready for the next evolution. That evolution is monthly swing positions, where the time frame expands, the work gets quieter, and the individual profits get significantly bigger. The principles remain identical. 2% risk, confirmation filters, asymmetric reward ratios, adding to strength, walking away when targets are met. Only the time horizon shifts. The bricks get bigger, the wall gets higher, and your dependence on weekly income gradually fades as your capital does more of the heavy lifting. For now, your job is elegantly simple. Even if it's not easy, cut losses fast, size small, wait for proof, grow winners with discipline, and when that Friday paycheck hits your target, close the shop and walk away. The market will be there Monday morning, ready to pay you again if you've preserved both your capital and your sanity by knowing when to stop.